Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Peter Schiff is CEO and Chief Global Strategist for Euro-Pacific Capital. He wrote the bestseller Crash Proof, How to Profit from the Coming Economic Collapse. He hosts the Peter Schiff Show live from 10 to noon Eastern, weekdays at schiffradio.com. And don't forget Peter's YouTube channel at youtube.com/Schiff Report. See and hear Peter at the 2012 New Orleans Investment Conference, October 24th, 27th. He is also keynote speaker at the San Francisco Hard Assets Conference. That's coming up November 17th. He's online at Europac.net and in Canada at Europac.ca. Peter, it's always good to have you back on This Week in Money.
Oh, thanks for having me on again.
Hey, you and I were talking about a movie called Americathon way back in the late 1970s. The storyline, something like this. The president of a bankrupt United States organizes a telethon in order to save the country. Now, back then, they played this as a comedy. In your book, you say, hey, declaring bankruptcy is really the only solution here.
Yeah, the problem is we're so broke. We owe so much money that it's impossible to use a telethon to get out of debt. So I think we just have to have a more old-fashioned bankruptcy where we, basically tell our creditors that we can't afford to pay and try to work out a reasonable restructuring of our liabilities. And I think we have to have everything on the table, not just the national debt, but all of the government's obligations, funded and otherwise, Social Security, Medicare, government pensions, things like that. Because a lot of promises have been made, and the taxpayers just can't deliver. And I think that a restructuring of our obligations is better than inflating them away, because that's what we're currently planning on doing, just printing a bunch of money so that we can pretend to pay our bills, but ultimately the people who get paid are going to get money that doesn't buy very much. In fact, the money might not buy anything.
Peter, you know and I know that's the only thing to do, but there does not seem to be any political will anywhere in Washington to do this kind of thing, does there?
Well, no. Because most politicians are concerned about their own reelection, and they're afraid that they'll put that in jeopardy if they level with the American public and let them know exactly how bad the situation is and what needs to be done to solve these problems. Even if you look at the debates we had between Romney and Obama, everybody promised no cuts to any of the big entitlement programs, Social Security or Medicare. They promised no government layoffs. They promised more money for national defense and middle-class tax cuts. So everybody agrees, let's cut taxes on the middle class, which is the majority of taxpayers. Let's increase government spending. Yet somehow we're going to do something about the deficit. But that's just going to make it worse.
We're talking to Peter Schiff here on This Week in Money. And if we're looking for villains, here's an unlikely villain in the whole piece. We're always used to pointing at the government, but it's the consumer who plays a large part in all this, right?
Well, the consumer is spending too much and borrowing too much, but it's the government and the Federal Reserve that make all that possible. If interest rates were a lot higher, it would be a lot harder for people to borrow money to buy things. If mortgage rates were higher, people wouldn't be able to borrow more money against their home equity and spend it. So you've got the government that is enticing the consumer into acting recklessly. Of course, the big government and all the taxes and regulations are making the economy less productive. A lot of Americans are forced to borrow money just to eat, just to buy gasoline so they can get to work. I think it's the government and bad monetary and fiscal policy that are driving the consumers into making so many bad decisions.
Peter, you're saying we can look forward not necessarily to a recession, but more of what you're calling a rationalization. We're simply going to have to adjust our standard of living.
Well, our standard of living is going to go down a lot. In fact, we're already in the process of that transformation where our standard of living is being ratcheted down. So the pain that a lot of people feel is not the temporary pain of recession, but it's a more permanent pain associated with a lower standard of living. And the reason our standard of living is going down is because we have destroyed the industrial base that made it so high in the first place. Mm-hmm. We no longer have the laissez-faire, free market policies that made us rich. We have the same kind of socialist policies that caused all four of my grandparents to flee their countries and come here. We have the same kind of government that my grandparents tried to escape. And so we're not going to be a wealthy nation anymore because we don't govern ourselves like a wealthy nation. and we've destroyed our industrial base. We have huge debts. We have massive trade and current account deficits. Big segments of our population don't work and are not productive at all. We've got millions and millions of people that are getting checks from the government, and it's undermining our standard of living. And so it's going to go a lot lower. And when we're going to see that is when the dollar ceases to really function as the world's reserve currency. The dollar is going to take a big drop in the exchange markets, international markets. Its value is going to fall, and the price of everything that Americans need to buy is going to go through the roof. And Americans are going to have to respond to that by just consuming a lot less and living a far more frugal lifestyle than what most of us have become accustomed to over the generations.
Peter, one of the things you're cautioning us not to be fooled by is government sleight of hand. We've been hearing a lot of figures out of the government, and they all make the government look good at this point. But you're saying it's not the economy that's growing, the vital part of what we're doing here, but it's money supply and inflation. Those are what's growing.
Yeah, the government is creating inflation, which makes it appear as if the economy is getting bigger, but it's not getting bigger. We're simply measuring the economy with money that's getting smaller. So the economy looks bigger when you're tallying it all up in depreciated dollars. The government doesn't accurately account for that. When they reported the GDP numbers about a week ago or 2 weeks ago for the second quarter, and they said the economy expanded by 1.3%, that's after they adjusted for inflation, which the government claimed was only 1.6% for the year. No, I don't believe that inflation is running at 1.6%. I look at prices, I buy stuff, and the prices of the things that I'm buying are going up by a lot more than 1.6% a year. And I think that if the government accurately reported inflation, they would have to report the economy contracting. But they don't want to report that. So it's all a lie. But I think a contracting economy is more consistent with the reality that I see with 15% of the population unemployed, with median incomes falling sharply. I mean, according to the statistics, American household income is down more during the Obama recovery than it was during the Bush recession. I mean, what kind of recovery is that where people did worse in the recession?
We're talking to Peter Schiff here on This Week in Money. Let's talk about the fiscal cliff for a second. Tax increases and spending cuts. Those are going to kick in January 1st. A lot of folks are afraid that that could push the U.S. back into a recession and make unemployment even worse. But, of course, it doesn't happen until after the election.
Well, we're going to go back into recession. In fact, we're probably already in recession. In fact, let's call it what it is. It's really a depression.
Yeah.
But, cutting government spending isn't part of the problem. I mean, that's part of the solution. Government is spending too much. That's why the economy is so weak. So these spending cuts that are going to kick in would actually help the situation. The problem is it's not enough spending cuts to make a big enough difference. We need more spending cuts. Now, the tax hikes, will they hurt? Sure, they're going to hurt. But you know what? It's better to pay for government with taxes than deficit. So to the extent that the taxes reduce the deficit, on margin, we're actually slightly better off. The problem, though, is the way the taxes, the way they're done. We're raising marginal income tax rates, which unfortunately is not an effective way to raise revenue, because oftentimes when you increase the marginal rate of tax, you discourage the activity that you're taxing. People don't work as hard if they don't get to keep as much as what they earn. And if you take money away from the entrepreneurs, the wealthy, the money that they're sending to the government in taxes is not the money that they were going to spend. It's the money that they were going to save or invest. So you're directly diminishing economic growth and employment opportunities. And as a result, we might end up, the government might actually collect less revenue despite raising taxes. So the type of taxes that we should be raising are the type of taxes that would directly hit consumption, not income tax rates. Mm-hmm. And so it's an ill-conceived method of raising revenue, and that is the problem. But the deficits are a bigger problem than the taxes or the spending. Well, we need to reduce the deficit. And unfortunately, I think that Congress is going to repeal these spending cuts and the tax hikes. And instead, we're just going to get bigger deficits, and that's a bigger fiscal cliff.
Peter, I love this piece in the New York Times today. Economists calling the fiscal cliff. They would like to call it a fiscal hill or a fiscal slope. The theory being if we could just get those tax increases and spending cuts, everything's going to be okay.
Well, I've been calling it a fiscal pothole to put it in perspective, because the real fiscal cliff is much larger, and it's looming out there, and that fiscal cliff is the one we go over when interest rates go up and we can't afford to service the debt anymore, let alone repay it. And now we have to make the very difficult decision of either defaulting on the debt or having runaway inflation. And either one is pretty bad. Of course, hyperinflation is worse than default, but we're going to have to do one or the other. Because we can't pay.
Yeah.
That's not even physically possible.
Great quote here from Bond King Bill Gross. The U.S. balance sheet is in flames, and the fire department is apparently asleep at the station house.
Well, the problem is that not only is it in flames, but the government is feeding the fire.
Yeah.
Instead of trying to put it out, we're just pouring gasoline on it to make it bigger.
Peter Schiff, our guest on This Week in Money. You know, in last week's Schiff report, you were talking a lot about jobs because that was in the news last week. President Obama says we're making headway on jobs. I guess that would be true if we were talking about government jobs.
Yeah, I mean, that's not headway, too. The last thing I want is more government employees whose salary I have to pay. I want to see big layoffs in government because the public can't afford to pay their salaries. And the problem is, most people who work in government, I mean, not only are they not productive in what they're doing, but they actually make it harder for the rest of us to produce anything. They simply get in the way of productive people, and they make it harder for them to produce. So the fewer government employees we have, the better. So the fact that we're adding government employees now is part of the problem. It's not part of the solution. But, you know, take that out of the equation. We're not creating new jobs. I mean, the unemployment rate supposedly dropped to 7.8% last month from 8.1%. You know, I don't know. I have a hard time believing that we did that by creating only 110,000 jobs. I mean, what probably happened is a lot of young people took some part-time jobs because their extended unemployment benefits ran out. And so they had to rush and take whatever job they can get, and all they can get was some, part-time job. But meanwhile, government tax receipts are falling, personal incomes are falling, the economy is barely growing, and that's only if you buy the government's claim that inflation is only 1.6%. So I think it's getting worse. And the real rate of unemployment, if you count the discouraged workers and the people working part-time who want to work full-time, it's about 15%. I mean, that's a disaster. And the percentage of adults in the labor force has collapsed since Obama became president. We've got the smallest percentage of people working since 1981. And if you take a look at adult males, it's the lowest since World War II.
Wow.
People aren't retiring because they're so rich they don't have to work. They're leaving the labor force because they're disgusted because they couldn't find a job. And a lot of them have just filled out, false disability claims. We've got millions of people since Obama became president that have now signed up for Social Security disability. They're not disabled. It's the economy that's disabled. They can't get a job.
We're talking to Peter Schiff here on This Week in Money, and the gold bugs in the audience want to know what's happening with gold and silver. You say it's breaking out, and of course the flip side of the coin, if you will, the dollar. It's going to be weak for the next couple of years.
Oh yeah, I mean I'm surprised that gold and silver prices aren't any higher. But you know what? Just buy. Don't look a gift horse in the mouth. I think it's a race to get out of the dollar. I think the last person in the dollar loses. The more dollars you have, the more you're going to lose. So I think you got to get into something real. I think silver and gold are among the best safe havens to store your value, store your wealth. And so, you need to buy. That's why I've got my own precious metals company, Europe Pacific Precious Metals. People can find it at schiffgold.com. And we sell and deliver physical gold and silver bullion, no numismatics, which I think are a waste of money. People get ripped off by salesmen. So we just sell, bullion, and we don't mark it up a lot. And through my brokerage firm, too, we've been buying gold and silver for my clients since 2001 at Europe Pacific Capital.
Peter Schiff is CEO and Chief Global Strategist for Europe Pacific Capital. See Peter at the 2012 New Orleans Investment Conference, coming up October 24th to 27th. And don't forget to check out Peter's site, Europac.net, here in Canada at Europac.ca. Peter, thanks for taking the time today.
Oh, anytime.
This Week in Money is archived online at TalkDigitalNetwork.com.
Eric Coffin is editor and publisher of the Hard Rock Analyst newsletter. He is online at hraadvisory.com. It's always good to talk to Eric Coffin. Eric, welcome back to This Week in Money.
Thanks, Bill. Thanks for having me.
We have some good news for gold this week, positive job numbers out of the U.S., and more trouble from the Eurozone after the ratings people cut to Spain's rating to just above junk. We also got some good news this morning, consumer sentiment jumping to the highest level in more than 5 years. That's got to be good for gold as well.
I think it is. I mean, it feels to me, I don't think they have a lot of company yet, but it feels to me like the U.S. is probably going to put up better numbers than people think. in the next 3-4 months. You haven't really seen the consumer confidence outside of existing home sales. You haven't really seen it translate into spending yet. But you got to think with confidence levels this high, guys are going to go out and start buying things. And I really think this is what the Fed was after. I mean, for all of the, moaning and wailing and gnashing of teeth about QE3, I don't think it was really so much about, getting interest rates down, a few basis points. Who really cares? I think it was actually more about goosing the market and making people feel better because their 401ks just got bigger.
Boy, you can sure point to QE3 as being the determining factor in what's happened in gold. Back in August, 1,600, now up close to 1,800. We're only $100 shy of last year's high.
Yeah, and I think we probably get there. It may not happen instantaneously, but I think Bernanke's, when he says I'm gonna keep the printing presses going until I'm really comfortable the employment numbers down to 6-7%. I don't think that happens very quickly. So I mean, there's a lot of money is going to get printed. Europe's a bit more problematic. I mean, the ECB is threatening, promising, whatever you want to put it, to come into the bond market in an unlimited way, but it's got strings attached, and that's really what's held things up. I mean, people might have expected more immediately, but the ECB hasn't actually started buying those bonds yet. I mean, the Spanish in particular have to agree to conditions. I mean, there have been recent comments from the Germans that they don't actually intend to add any extra conditions, and there's been persistent rumors that once the Trioca comes out of Athens and comes up with whatever ugly number, because everybody thinks it's going to be even uglier, just like it has been the last 10 times. There's sort of rumor running around in Europe that once that number is being divulged and the EU says yes or no, we'll cut another check to the Greeks, that they want to deal with Spain at the same time. If that's the case, then that's when the printing presses go on. And in a rational world, that would make the euro drop because they're printing all these extra euros. But I think given how horrendous the situation has been over there, I suspect hearing that the ECB is going to turn on the printing presses would actually make the euro go up, which is going to help, again, is going to help the U.S. dollar-based gold price.
Well, wait a minute. We live in a rational world here?
No, not at all.
Now, QE, obviously, and all the money printing, lighting a fire under gold and other precious metals. Two of the big factors this week also, the dollar index and oil prices. It is weaker and oil prices are slightly higher. That's got to be a big influence on gold prices.
Yeah, people do tend to trade them against each other. I mean, that sort of trio, the U.S. dollar, oil, and gold, there do seem to be a lot of traders that trade pairs between, dollar oil, gold dollar. And oils, I mean, I've been a little surprised how strong the oil price is, but some of that's political, but again, some of that may be, some of that might be stealth good news. Maybe that's the market telling us things aren't quite as horrendous as everybody seems to think they are. Gold
trading around 1770 today, and it appears to be kind of trading at a sideways range between 1760 and 1780. And a lot of folks are wondering, where do we go from here? What happens next with gold?
I think we probably get a bit more sideways. I think it'll take, I think we probably need a couple of fairly, stronger numbers out of the U.S. I think any kind of a deal in Europe, if you see the Spanish say, yeah, okay, we'll do a bailout, anything like that that's going to really expand the European money supply, I think that would goose the gold price. And I think decent numbers that sort of pull the major markets, because the major markets are close to 5-year, the U.S. ones anyway, are close to 5-year highs, and they're also sort of sideways. And if we get enough decent earnings or 2 or 3 good economic stats in the next couple of weeks that shift that up again, I think the gold price just goes along with it.
We're talking to Eric Coffin from HRAadvisory.com here on This Week in Money. Somebody said yesterday that gold kind of looks like it's coiling up a little, and that maybe they thought this is what you see before some kind of a breakout. What do you think?
I think we're probably pretty close to one. I mean, I think it's going to come with an equity market breakout. I think they got to come together. I mean, essentially risk on trading comes back. I mean, people got a bit nervous. The economic numbers were not great, except for 2 or 3 cases. Plus, we have started the third quarter earnings season, and nobody was expecting the numbers to be good. I mean, the consensus is that the earnings are going to be lousy. They're going to be negative. I imagine at the end of the day, the earnings are going to be a little bit better than consensus. They usually are. I mean, these big companies are pretty good at guiding analysts in a few percent below what they actually deliver. So I think enough of those slightly stronger numbers come out and settle people down. Then I think you see things start to lift a bit. The one thing that could be, that could be the big determiner, obviously, is the U.S. election.
Yeah.
Who ends up winning that? But fairly soon after that, somebody in Washington's got to sit down with somebody else in Washington and do something about the fiscal cliff. That's still kind of hanging over the market. I'm just cynical when it comes to political stuff, so I'm assuming they're going to kick the can down the road. I mean, that's what they did the last 20 times.
Yeah, no matter who's in power, right?
Yeah, I'm not expecting a deal so much as some kind of a BS deal that lets them ignore it for another 6 months or a year. I mean, that to me, that's the most likely outcome. Not that they're going to fix it, just that they're going to kick the can down the road again.
I guess once we know what happens, things will be a little more clear. But right now, it's just that uncertainty that markets and precious metals don't like.
Yeah, and I do think that if you look at U.S. markets in particular, I mean, they're back to almost where they were when they topped out in 2008. And it's pretty hard to look at the U.S. economy with a straight face and say, well, yeah, it looks as good as it did in 2008. I mean, it doesn't. A lot of the move in the equity markets is the same thing as the move in the gold markets. It's rock bottom interest rates and money printing. And, it's been good for both.
Eric, seems you can't talk about gold these days without talking about manipulation. A couple of quotes here I want to get your opinion on. Number one from James Turk. More paper gold in existence than actual physical gold means we could soon be seeing a massive short squeeze in gold and silver. What do you think?
I'm fairly skeptical about that, to be honest. I know James and John and 10 other guys all have that theory, and yeah, under the right circumstances or the wrong circumstances, depending on what side of the trade you're on, that's theoretically possible. But I mean, when you look at the futures markets in general, it's pretty common that there's more paper, whatever.
Okay.
Gold, corn, soy, oil, whatever. I mean, it's just the way that the thing, this stuff trades. I mean, the open interest tends to exceed the physical metal or grain or oil or whatever. That's not that uncommon a situation. It's really whether the guys can close their trades out. Mm-hmm. You could in theory, if something really big happened. I mean, if Iran detonated a nuclear weapon or something could happen so fast that you could get like a $200 increase in the gold price, like boom, like that. But it would take something like that, I think. Yeah. I don't think it would just be a trading thing where suddenly you'd get this short run.
Here's John Embry. We're witnessing a war between the physical buyers, the Eastern central banks, and the paper manipulators. Those are the commercials or bullion banks. Well, he's making sense, is he?
To a point, but I mean, most of the bullion banks are bullion banks. I mean, they make money selling bullion. And a lot of the hedging that they do, I think, is commercial hedging, which is why it's termed that way by the CBO. I mean, I think too much gets read into that sometimes.
Okay.
I can recall a long time back having it was a friendly argument over a beer with a couple of these guys, and my comment, and it's. My comment's a little less strong now, given what gold's done in the last 10 years, but it was more to the point of really why would these guys bother? I mean, does the people outside of our sector and people outside of the futures market that trade this stuff, does your average guy in the street care enough about the gold price? I mean, do they read so much into the gold price that all of these institutions are going to go to that much trouble to manipulate it? I have my doubts. I mean, I think 8 out of 10 people you run into on the street, one, don't even know what the gold price is. Yeah. 2, don't care.
We're talking to Eric Coffin from HRAadvisory.com here on This Week in Money. Speaking of the guy in the street, look at the amount of money, Eric, going into gold ETFs and ETNs. Almost $8 billion in the third quarter. That's the best in 2 years.
I think the ETFs in gold's case in particular are being a big help. The one place where I do agree with John and James and a few other guys is ETFs do make me a little bit nervous. Because really, whenever you're trading ETFs, you are trading something synthetic, and people tend to view them, retail buyers especially, as saying, "Oh, well, I'm buying a piece of that index. I'm buying that amount of gold." It's like, well, no, you're not. You're buying a fund run by a bunch of traders running derivatives back and forth to try to mimic that other market. And if you want to see something where you can have real problems when there's a big move one way or the other, it's ETFs. I mean, I've seen a few of them blow up in the last few years, and I do agree with Embry and Day and Turk and a bunch of other guys that those things are a little bit dangerous. That said, it's kind of become the world's second biggest central bank holder in a sense. Mm-hmm. I mean, they have bought a lot of gold and taken a lot of gold out of the market. It's held, but I think if you think gold's going to $5,000, I think you should just go buy some gold.
Now, you were talking about central banks. They've set a new record this year. They bought over 150 tons of gold in the second quarter. That's interesting.
I think everyone, central bankers are, for all of the the crap that we heap on these poor guys. I mean, most of them aren't stupid, and I think anyone looking at the U.S. and most people, when they think of gold and the gold price, they think in U.S. dollars. And a lot of these guys are holding U.S. dollars as a reserve currency. You look at the fiscal situation in the U.S., but more to the point, it's not even the fiscal situation, it's more the political situation. It's very difficult for me to conceive of any way of the U.S. to get off the debt track they're in other than inflating their way out of it.
Yeah.
Not because that's the best way to go, but because that's the most painless way to go politically. And I think all of these central bankers are looking at the U.S. political system and saying, if they're going to take the easy way out, they're just going to keep printing.
From gold bullion to gold miners, Eric, you mentioned in the last HRA Advisory Journal that the TSXV still at what you're calling depressing levels. What's going on here?
Well, it got a bit of a bounce in August, which is kind of what we thought would happen. I mean, partially like everybody, we were hoping that Bernanke would pull the trigger, which he's done, and we've seen a decent bounce. And what I'm starting to see is more financing, because that's always a big issue for the explorers. I mean, it's a negative cash flow business, and at the end of the day, if they can't raise money, they can't do anything. I am starting to see the number of financings go up. It's a very top-down thing. I mean, it's the guys with big exploration successes and the guys that are, development companies already that have resources. Those are the ones attracting money. I'm still not seeing volume levels overall that are making me happy. Mm-hmm. I think we probably need to see the overall volume in that market go up another 50% to really get a sustainable rally. I mean, I think that's going to happen. I mean, if the bounce up in the major indices in gold that I'm expecting happens in the next month or so, I think we're going to get the same thing in the venture. I mean, I do think we're going to have a decent rally, but we definitely need to see more volume. We're just not seeing enough people in the markets. Everybody's still on the sidelines, really.
So volume is the problem. Are we going to see any distinction between the senior golds and the junior golds over the next while?
I think if we get back through 1800 and stay there, you'll probably see more. You'll see more movement in the producers. I mean, it's been difficult for producers because they saw a huge expansion in costs. I mean, even though the gold price was going up, the cost base for a lot of these guys was just exploding. Manpower, capital, everything was going up really fast. And they had a big margin squeeze there for a while. And I think the market needs to see a bit of a step up in gold and see their margins broaden out. And big gold producers have shifted from being, bought 20 years ago, 10 years ago, smart guys like John Embry and Jim Turk were buying gold producers and saying, I'm buying this because gold's $300 and I think it's going to $3,000.
Yeah.
And a lot of people were buying it for that reason. They were buying ounces in the ground. They weren't buying earnings. They didn't even care much whether the company was making money or losing it. They were just buying reserves. Now that gold's gone up 500%, it's a lot tougher to make the case that it's going to go up another 500%. And these companies have seen their PEs contract, not to something horrendous, just to something sort of more normal. And I think what you're really going to see is, one, probably better prices as the gold price moves up a bit, but I think you'll see more and more differentiation. The guys that can lay out a case for real earnings growth, in most cases based either on production growth, but probably on a combination of production growth and bringing in lower cost per ounce production. Those are the guys that are going to be the real stars.
Eric Coffin is editor and publisher of the Hard Rock Analyst newsletter. He's online at hraadvisory.com. Hey, Eric, thanks for this.
Sure.
This Week in Money is archived online at talkdigitalnetwork.com.
David Morgan is our guest. He is our go-to guy on silver. You can find him at silver-investor.com. It's the home of the Morgan Report. And don't forget, also on YouTube, he's at Silver Guru. And on Twitter, you can follow him at SilverGuru22. Hey, David, it's good to have you back on This Week in Money.
Phil, it's great to be back with you.
Less than 2 weeks until the Silver Summit's 10th anniversary. That's coming up Thursday, October 25th, and Friday, October 26th, in lovely Spokane, the heart of Morgan country.
Oh, thanks.
And, of course, we can check all the information out on CambridgeHouse.com. Give us a sneak preview of what's going to be going on.
Well, such notables as Eric Sprott will be speaking, myself, Jeff Christian, Jeff Berwick, a new guy named Chris Dwayne, who has a huge following in the silver space. So it's really for all things silver. It's mining companies, it's metals companies, it's all kinds of things related to the silver market. Women in mining, which is something we don't talk about very much. There's a group called Women in Mining here in the local area, and they're very active in the mining sector. So, and we're just right next to the Silver Valley, which is in Idaho, one state away. So a lot of those folks will be attending. So it's really quite an event. After 10 years, Phil, we've really developed a worldwide presence, and we have people from basically all over the globe that attend the Silver Summit.
Just off the top of your head, Dave, what was the price of silver 10 years ago?
Boy, that's a tough one. I would say probably under 10.
Okay. Start of the year, 2012 at $28. It's been as high as 35. Been on a tear since the end of June, and currently trading just under $34. What is going on with silver?
Well, as always, Phil, it moves up and down like anything, but we've had a very tightly held supply for quite some time. And when you have a tight float like you would have in a stock, or a tight float in a commodity like silver, any new buying tends to push the price up fairly easily. And that's where we are right now. So there's always the short-term traders, the people that buy, just to look to lock in a gain for a day or a week or maybe a couple weeks and that kind of thing. And I think that's where we're at presently. I think some of the short-term guys are ready to get out. I mean, silver has made a run from basically 28 to 35 on the spot month, basis the spot month, I should say. And so some of those guys are ready to bail out. We'll probably get a little bit of softening in the market here on a short-term basis. But longer term, there is nothing that beats silver as a long-term investment as far as protecting yourself from an inflationary depression. I was on a previous show this morning, and we were talking about that people wanted to know again and again, and still do, how does silver act during a deflationary environment? And I really wasn't sure several years ago, but Phil, I'm going to guess it's been, 7 years or so. And I went back and reread Silver, the Restless Metal by Professor Roy Jastrom, who, after he wrote Golden Constant and looked at what gold did during deflationary and inflationary times, went back and did a similar study on silver. And silver doesn't do as well as gold during a deflation, but sometimes it does better than gold, but it's a mixed result. You can't say with silver that no matter what happens, deflation or inflation is going to protect you. Gold, you could pretty much make that statement. With silver, he did make a conclusion, and that was in an inflationary depression where you would continue to print currency until it becomes worth less until it's worthless. That is a silver investment. Okay. Nothing in his study did better than silver does. And that's over centuries. This is not looking at one case study. This is looking at over century after century after century. So I think it's important to point out to our listeners that if that's what they think is going to happen, or even if they don't, that they should at least have some silver in their portfolio to protect against that. And I think it's an eventuality. There's never, ever, ever been a situation where an unbacked currency hasn't gone the inflationary depression route. Only when you have a gold-backed currency have you had deflationary depressions. The reason you had a deflationary depression in the 30s in the United States was it was gold-backed. Yes, Roosevelt came in and changed the gold contract with the American people and said, Americans, you can't own gold, turn it in. Nonetheless, that gold was sent to the banking system to back the dollar internationally, and it was held that way all the way through the Bretton Woods Agreement until the gold window was closed, August 15th, 1971. So gold has certainly had a very important role in monetary affairs, as silver has for a long, long time. But again, thinking about what's going to happen in the future, the history speaks very loudly, very clearly if you study the topic, and that is that silver, not gold, is the one that does the best. Not saying gold won't do good, it certainly will. When you have a government or governments that are going to continue to try to get out of this mess by printing and printing and printing some more.
David, let's look at the technicals behind silver. It looks like silver behaving much the same as gold. Looks like it's coiling up and getting ready for the next move.
I think you're right, but basis the short term and the volume and the relative strength and the things I look at, I think you're going to get a bit of a softening here. Mike Maloney, good friend of mine, goldsilver.com, put out a release to his subscribers recently. And he has a technician that does this for him, and that's fine. The guy's good. I do my own work on that. Regardless, they're looking for a dip to 31. I looked at the charts. I did an update for my members. I showed them explicitly what I see in a future short-term basis. And again, I think we could get some kind of a softening here. I don't see us going to 26 again. I don't even see us going below 30 again. But we might wash down to 32.5 or 31 level. That's possible. I'm still looking for 35 to 40 by the end of the year, Phil. I think if we get some kind of a wash, that'll be brief. It'll get rid of the weak sisters of the short-term traders, and then we're going to come snapping back rather quickly. So the coil that you're referring to, I agree. I just think that you might get a bit of a softening and kind of a bit of a bear trap, if you will. Bounce down, and the bears will say, ha-ha, look at that, silver's weak, gold's weak, and it doesn't last very long, and it snaps right back.
U.S. election, obviously on everybody's mind these days, is coming up in a month or so, and a lot of folks saying that prices are going to pretty much stay sideways until the end of the election, and then maybe after the election, depending on what happens, the precious metal prices will surge. What do you think?
Well, I think it depends who gets elected, and I think regardless, the long-term trend is very clear. It's up. But if Obama gets reelected, I think it'll be an immediate run in the precious metals. I think a lot of people that are on the sidelines or people that are even invested will invest more, and new people will come in. So I'm looking for an Obama win to be very bullish for the metals immediately. A Romney win, I think, will soften the market for some time until it's very clear that the rhetoric of these politicians is something that sounds good on TV. I don't waste my time watching it, but some people do. And the rhetoric is all that. It's just words, hot air coming out of a politician, and don't believe much of what they say because what they do is what's important, and neither one of them are really going to change the acceleration to the edge of the cliff. I mean, the Democratic Party might have their foot on the accelerator a little greater than the Republicans, but I don't think it makes much difference. We're headed toward the cliff. We're very close to the end, and it's going to happen unless there's huge policy shifts, and these policies are not going to be enacted by any of the candidates that are presently available.
We're talking to David Morgan here on This Week in Money, and let's talk about one of the other big factors affecting silver over the next little while. News from the Eurozone. It seems that money printing is just about everywhere these days.
It is, and again, going back to that study with Professor Jastrom, I mean, if you really understand what's going on and you want to prepare for it financially, silver is the place to be. And silver is really tightly held right now. We're going to see possibly a default in the ability to deliver silver or gold or both in size. Obviously, the little guy, the people that have, silver bags or silver bars or whatever at the retail level, there'll always be exchanges for silver for another commodity or land or paper dollars or whatever. But as far as coming into the market and being able to buy, 10 million ounces of silver, 20 million ounces of silver like Sprott Asset Management or Sprott, the PSLV, the Sprott Physical Silver Trust has done a few times, I seriously think, that the ability to do that is going to end at some point. So if a PSLV or a large hedge fund that buys the physical metal comes in and says, I want 30 million ounces of silver, they're going to say, hold on a minute, we'll work on that.
Yeah.
That I think could happen.
What is happening in the silver ETFs? There seems to be a lot of cash going into precious metals ETFs generally. What's happening with things like the SLV?
Yeah, the ETFs as a group hit a record high as far as amount of metal held about 2 or 3 weeks ago. So that's another, good, clear signal that regardless of the price, which has been moving up, but it's not in the new nominal high territory. The funds, the ETFs, are really taking a lot of new money in, and it's obviously, making new highs as far as physical, purportedly, and I want to use the word purportedly, physical metal being held.
We're talking to David Morgan here on This Week in Money. Somebody asked me the other day about coins, the coin market, silver coins. What's going on there?
That's not talked about enough, Phil, in my view. What's interesting about the coin market is to compare it to the bullion market. I mean, you hear analysts talking about, there's 1 billion ounces of silver for investment, and that's true on the bullion side only. In other words, commercial bars, roughly round numbers, about 1 billion ounces. But equally important is the amount of silver rounds and silver coins, and rounds are considered coins, and they are. All silver coinage is also about 1 billion ounces, and that's investment form. In fact, that's one of the most important investment forms, is what's bought by the public or the small investor over time. So if you add the coinage and the bullion bars together, you're looking at about 2 billion ounces. Okay. And they're roughly 50-50. In other words, half is in bullion form and half is in coin form. So it's a very important part of the market.
Dave, let's talk about the Morgan Report and your end of the world special. This is intriguing.
Well, Phil, I'm probably the most undervalued as far as what you get for your money in the industry. And it's been that way for quite some time. When I started the Morgan Report, I actually based it on the price of silver, and the price of silver was under 5, so I charged like an ounce of silver per month, which 12 times 5 is $60. Believe it or not, I had well under 100 subscribers at the time. It was $60 a year. We moved it up to 78, and then we moved it up to 99, and then we moved it up to 129, and that's been over the last 13 years. So we're getting ready for a price increase, but I want to do something special for all the people that are loyal members, and that is that they can lock in their price at this current level for as long as they wish. As long as their membership is valid, they'll continue at $129 a year. And I also wanted to make that same exact offer to anyone that wants to come in before the Mayan calendar due date, which I thought was a cute way to do it. Instead of January 1st, 2013, I thought I'd make it the end of the world special. So if anyone out there has ever thought about getting on our basic or advanced services, you want to check out the video that's on the front page of silver-investor.com and listen to what I have to say. And, you could sign up and become a member and decide after 30 days or before 30 days it's not for you, opt out and get all your money back. It's, we're not here to twist anybody's arm. But if you do like it, you can stay on board for that price and, again, lock in forever. The prices are going up roughly 40% across the board, again, after December 21st, 2012.
You'll find David Morgan at silver-investor.com, home of the Morgan Report. Don't forget the Silver Summit's 10th anniversary. That's coming up in a couple of weeks, Thursday, October 25th, Friday, October 26th, in lovely Spokane, Washington. You can get more details at cambridgehouse.com. Hey, David, always fun. Thank you, sir.
My pleasure. Thank you.
Thanks to our guests, Peter Schiff, Eric Coffin, and David Morgan. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.